If you've ever wondered why it feels like stocks are always doing the opposite of what you need them to do, congratulations, you have already taken your first step in understanding the stock market. It sounds simple, but somehow it is one of the most confusing, chaotic, and emotionally exhausting things in the world. One day everyone is making money and celebrating. The next, the market drops a few percent, and suddenly people are predicting the next Great Depression. Let's understand this concept once and for all. The stock market is where people buy and sell pieces of companies called stocks. When you own a stock, you technically own a tiny slice of that company. If the company does well, your stock becomes more valuable. If it doesn't, you enter the emotional roller coaster of investing. And no, the stock market is not just one big thing. It is actually a collection of different markets, the biggest being the New York Stock Exchange and NASDAQ. These places handle trillions of dollars in trades, where investors, hedge funds, and day traders all try to outsmart each other, while also pretending that they know exactly what's going to happen next. Now, when people say the market is up or the market is down, they are usually talking about a handful of indexes. The Dow Jones Industrial Average tracks 30 big companies. The S&P 500 tracks 500 of the largest companies in the US, and the NASDAQ focuses more on tech stocks. These indexes act like scoreboards for the economy, though sometimes they move in ways that make absolutely no sense. For example, unemployment could be at record highs, entire industries could be struggling, and yet stocks are rising. Why? Well, because the market does not care about your feelings. It moves based on corporate profits, investor confidence, interest rates, and sometimes just pure speculation. Speaking of speculation, let's talk about how people actually make money in stocks. There are two main ways to make money in the stock market. The first is capital appreciation, which is just a complicated way of saying buy low, sell high. You buy a stock for $50, it goes up to $100, you sell, and boom, you made money. This sounds simple, right? But too bad almost no one actually does this correctly. The second way is dividends. Now, some companies take a portion of their profits and pay them out to shareholders. If you own dividend-paying stocks, you get paid just for holding on to them. It's like passive income, but with more volatility and less certainty. Of course, making money in stocks is not as easy as it sounds, because humans are emotional, impatient, and easily influenced by bad financial advice on social media. Let's talk about the most common investing mistakes. First, buying stocks because they feel like a good idea. This is how people end up throwing money away at companies with no profits, no clear business model, and CEOs who tweet too much. Second, trying to time the market. Investors love to believe that they can predict exactly when stocks will go up and down. But if professional hedge funds with teams of experts and AI algorithms can't do it, your cousin who just has a feeling probably cannot either. Third, panic selling. The market drops, people freak out, they sell everything at a loss, and then the stocks go right back up. Rinse, repeat, regret. And then there are the meme stocks. Now, a while ago, GameStop and AMC skyrocketed because Reddit decided to take on Wall Street. This made people fortunes. Others lost everything. What did we learn, though? Well, mostly that the internet is capable of causing complete financial chaos whenever it feels like it. But let's be real. Most investors aren't trying to beat hedge funds or become overnight millionaires. They just want to grow their money without stressing about it 24/7. So what's the smart way to invest? Step 1. Don't put all your money into one stock. No matter how much you love a company, it can fail. You have to diversify. Step 2. Stop checking your portfolio every 10 minutes. Stocks go up and down. The long-term trend is what matters. And step 3, invest in index funds. Even Warren Buffett, one of the greatest investors of all time, says index funds are the way to go for most people. Of course, there is always the fear of a market crash. Every few years, something happens that sends stocks tumbling, and people start predicting the end of capitalism. The Great Depression, the dot-com bubble, 2008, 2020, market crashes are inevitable. But don't forget, the stock market always recovers. It might take months or years, but historically every crash has eventually led to new all-time highs. So, does investing sound terrifying yet? Good. That means you're paying attention. At the end of the day, the stock market is a game of patience, discipline, and not letting emotions ruin your strategy. That was all for today's video. If you want more casual and quick explanations on different topics, make sure to subscribe to my channel. Goodbye.